All right, picture this. You're in your late 30s or 40s. Life is busy, you're hitting your professional stride, and then bam, a significant chunk of money lands in your lap. Maybe it's a bonus you worked to the bone for, an inheritance, or the sale of a property. The first thought is great. The second thought is, oh no. You know you need to get this money working for you, but you're paralyzed by one question. Do you go all in at once or do you ease in slowly? I know it sounds dramatic, but look around. The decision you make right now could be the defining move for your wealth over the next 20 years. This isn't some textbook theory. It's a battle between cold, hard data and your own human brain. And for us at this stage of the game, getting it right is everything. So let's tear apart one of the biggest debates in investing: lump sum versus dollar cost averaging. For most people, it's an interesting question, but for us, with a solid 20-year runway to retirement, the stakes are completely different. We have enough time to recover from a mistake, but not so much that we can afford to make a massive one. Let's break it down. Imagine you have $120,000 in cash, ready to invest in Bitcoin. With lump sum investing, LSI, you put all $120,000 into Bitcoin on day one. You're all in. The logic is simple. Historically, Bitcoin has trended up over time, powered by its innovative decentralized blockchain that challenges traditional finance. The sooner your money is in, the more time it has to grow. It's about maximizing your time in the market. With dollar cost averaging, DCA, you play it more cautiously. You break up that $120,000, investing $10,000 every month for a year. It's the same disciplined move you make with your 401k contributions. When the Bitcoin price is up, your cash buys fewer Satoshis. When it dips, that same cash buys more, automatically. So what's the real play here? Is it better to get in fast, or is it better to manage your own psychology? Keep in mind, Bitcoin is highly volatile, and investing involves risks including the potential loss of principal. Past performance isn't a guarantee of future results. First, let's look at what the spreadsheets say. When you strip away the fear and the noise, the data is brutally clear. Study after study from giants like Vanguard and Morningstar have come to the same conclusion. Lump sum investing wins about 2/3 of the time. A huge Vanguard study looking at markets across the globe, updated with data through 2022 and still relevant as of early 2026, found that going all in on day one beat DCA roughly 68% of the time. Over a single year, that lump sum investment in an asset like Bitcoin was, on average, 2.4% ahead of the DCA strategy, based on Bitcoin-specific analyses. Other analyses show it outperforming as much as 75% of the time over longer periods. Let that sink in. Why? The reason is opportunity cost, and it's a silent killer. Bitcoin trends up over time. Every month your DCA money is sitting in cash. It's not working. It's on the sidelines, getting eaten by inflation, while Bitcoin moves on without it. When you choose DCA, you are fundamentally betting that the Bitcoin price is about to go down. But history shows that's a losing bet 2 out of 3 times. Of course, markets can change rapidly, and Bitcoin's volatility means bigger swings. Always do your own research and consider your risk tolerance. So, if the math is so one-sided, why is this even a conversation? Because the answer has nothing to do with numbers on a screen, and everything to do with what happens in our heads when our money is on the line. The spreadsheets don't lie, but they don't tell the full story. The real world is driven by fear, greed, and anxiety. This is where DCA becomes your secret weapon. The main reason comes down to one powerful force: the fear of regret. And I want you to be 100% honest with yourself here. How would you truly feel if you dropped that entire $120,000 into Bitcoin on a Monday, and by Friday, the price had crashed 20%? The pain would be sickening. You'd kick yourself endlessly. That feeling is so powerful it can cause you to make the ultimate mistake: panic selling at the absolute bottom. DCA is the system you build to protect yourself from yourself. It's a psychological safety net. By easing into the market, you sidestep the risk of catastrophic timing. If Bitcoin drops after your first few investments, it's not a disaster. It's a discount. It feels like a small win because your next buy is going to get you more Satoshis for the same price. For those of us with mortgages, kids, and the pressure of our peak earning years, this sleep at night factor is everything. It provides the emotional stability to stay in the game. Because what good is a mathematically optimal plan if you're too terrified to follow it? The best plan is useless if you can't stick with it. If that fear will make you hesitate and leave your cash on the sidelines for months or years, you've already lost. In that scenario, a disciplined DCA plan is infinitely better than a perfect lump sum plan you never execute. If this breakdown is helping you think about your strategy in a new way, do yourself a favor and hit that subscribe button. I want you in this community as we navigate the world of Bitcoin and crypto investing together. Now let's get into a framework to help you make the right choice. So how do you actually decide? You in your late 30s or 40s with a 20-plus year horizon. Let's build a simple framework. Question 1. Is this a true windfall or just your paycheck? If it's money from your regular income, you're already dollar cost averaging. That's a fantastic system. Keep doing it. This debate is for when you have a big pile of cash sitting there right now. Let's say anything more than 10% of your current net worth. If that's you, move on to question 2. Question 2. Be brutally honest. Could you watch your portfolio drop 20 to 30% and not sell? This is the most important question. Think about past downturns. Did you feel that knot in your stomach? If your honest answer is, yes, I have the stomach for it, I trust the process long term, then the data is screaming at you. Go with the lump sum. You have more than enough time to recover from any short-term drop, and the odds say you'll end up far wealthier for it. But if your answer is, no, a huge drop right away would freak me out and I might panic, then the path is clear. Choose dollar cost averaging. Spread your buys over 6 or even 12 months. It will minimize that risk of regret and keep you in the game. The tiny bit of potential return you give up is a small price to pay for peace of mind. Question 3. Still frozen? Try the life hack, the hybrid approach. Who says you have to pick a side? There's no rule book. A powerful strategy is to invest a big chunk, say 50%, as a lump sum today. Then DCA the other 50% over the next 6 to 12 months. This is the ultimate compromise. You get a huge piece of your capital working on day one, capturing potential gains. But you're also keeping some powder dry, which gives you that psychological safety net and the chance to buy more if Bitcoin takes a hit. For many of us, this hybrid model is the perfect move. It respects the math, but it also respects the fact that we're human. So, what's the final answer? The data gives a clear edge to lump sum investing. We can't deny that. But the conversation isn't over because we are not robots. For an investor at our stage of life, this isn't about finding the one perfect strategy. It's about finding the strategy that is perfect for you. If you're built for the risk and have the discipline to see it through, the data says a lump sum is your fastest path to building serious wealth. However, if the thought of going all in fills you with dread, dollar cost averaging is a brilliant strategy. It builds discipline, it kills the risk of regret, and it helps you sleep at night. And that might be the best return on investment there is. In the end, the winning move isn't about perfectly timing your entry. The only thing that matters is maximizing your time in the market. The best strategy is the one that gets your money in the game and keeps it there for the long haul. Whether that's a lump sum, DCA, or the hybrid play, the only real way to lose is to stay on the sidelines. Now I want to hear from you. You get a $100,000 windfall tomorrow. What's your move? Let me know your strategy in the comments below.